What are some red flags that investors should be, on the lookout for when choosing a tax advisor?
I typically say you get what you pay for. If you find someone who is extremely cheap, just be very concerned about that. Another thing, though, that I would say is just how much experience do they have? People on TikTok, Instagram, whatever, they've got big followings, and it's because their advice sounds really nice. They will tell you things like your Rolex is going to be deductible because it's inventory. Or they're going to tell you things like, hey, your birthday party with all of your family, that's a networking advertising event. Okay. So there's just silly things out there that if it sounds too good to be true, should be a red flag.
Welcome to the On the Rise podcast, where we talk about time freedom, passive investing through real estate, finance, and mindset. Let's dive in. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice. I am not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. All right, welcome back on the Rise podcast, listeners. Thank you again for jumping into yet another episode of On the Rise. I'm your host, Jeremy Dyer. Thank you so much for joining us today. I've got another amazing guest with me, as I always do, of course. I've got Ryan Carriere. Ryan, welcome to the show.
Thanks for having me, guys. Pleasure to be here.
I'd like to also let our listening audience know that I've got Nick Stromwell here, our director of capital formation as well, kind of joining me on the call here with Ryan. So Ryan, again, really appreciate, you being with us today. Would love for you just to kind of let us know a little bit more about Ryan Carriere, your journey, into real estate, in investing, what you're focused on today, et cetera.
Yeah, I'll start with, I'm a Minnesota native, like these two guys here. I actually just moved, like I was telling these guys before the show, kind of northwest of the suburbs here in the Twin Cities. But yeah, went to college here, St. Thomas grad in St. Paul area. And then kind of from there, just professionally, went to Honeywell for a couple of years and then worked at 3 other CPA firms. And as of today, now we're working in my own CPA firm, which is called Carriere Tax Consulting. But yeah, just kind of after graduating from college, got into when I was at Honeywell, just kind of a general accounting type role. While I was there, got my CPA. And actually, while I was getting my CPA, pretty shortly after that, got introduced from a good friend of mine into BiggerPockets, which I think a lot of people, as we have gotten into kind of our generation into real estate investing and kind of the appetite for that and the interest in that, BiggerPockets, I think for a lot of people that I know, has played a pretty pivotal role in that. So started listening to the podcast. And as I was now a CPA, got interested in, real estate investing could be a good asset class for me. And I actually bought my first property, which is a single family home in kind of the U of M area, basically early 2017, and actually bought that with a friend. And he and I put down 50-50. We did the whole house hacking thing. We lived in the basement, which was barely a bedroom, to be in there for about a year and a half or so. And then we were renting out the upstairs. And one of the things back then in kind of 2017, 2018, we were renting to good friends who were also just kind of recently graduated from college, but we actually had the master bedroom on Airbnb for probably a year or so. Maybe it was 2 years. I can't even remember how long that was. So it feels like, looking back at that time, kind of the wild, wild west of Airbnb, where you could just put up a bedroom and, anyone would kind of stay there for $50 a night or whatever it was. And we're like, hey, it's a little bit higher than if we were to rent this out for a 12-month lease or even month to month. And so we were pretty happy with that and got to meet some very interesting people who were looking to stay in that area for just a short period of time. But yeah, so I was there, still actually have that property, was going to sell it this year and had a snafu and didn't sell it, probably will next year. But then kind of since that property, got married and so forth. But just on the real estate side, bought a fourplex after that. Another kind of partnership with another good friend who's actually my realtor. And then we bought another duplex after that, a single family, and then another duplex with another couple as well. So at one point, we've now sold the fourplex this year, actually just in June. But at one point, I think we had 5 or 6 properties, kind of a mixture between single family duplexes and the fourplex. Was kind of the mix. And just at where I'm at in this kind of stage of life, from the time that we started to acquire properties to where we are now, we're just kind of looking to not be so active. Yes, we have a property manager for all of our rentals, but just kind of looking to be a bit more passive, honestly, in nature, and kind of move some of that to either stocks or limited partnership investments, things like that. So we're kind of liquidating those and kind of taking the equity, moving those elsewhere. But yeah, so then just I still own some of them, like I said, selling some of them right now in the process. And done another house hack. We just moved from a home in Bloomington, and we're renting out the basement, living in the upstairs, even while we had kids. And the lady downstairs was great. She was actually a nanny and totally understood kind of the situation and very patient with us. But yeah, now just I'm kind of jumping all over the place, but kind of real estate kind of mixed within just the CPA world. Those kind of like came together. And you guys may be familiar with Brandon Hall at Hall CPA. And I actually heard him early on in the BiggerPockets podcast, 2017, again, probably right around that time, 2016. And that actually got me kind of introduced into, oh, you could be a CPA who specializes in real estate, the real estate tax code. And that's where kind of like I blended like my interest in real estate and my real estate investing and my career in being a CPA and kind of blended those two. And so that kind of brings me to somewhat today. Yes, I've kind of skipped a bunch of things and I'm happy to take questions you guys have. But kind of where I'm at now with Carriere Tax Consulting, which is a pretty new firm, but I'm basically going to be helping high income earners who are looking to use real estate tax strategies to pay as little as possible in tax. That could be things like real estate professional status, the short term rental tax strategy, cost segregation studies being a part of that. Maybe people are selling and doing 1031 exchanges and all that sort of thing. But really, kind of who high income earners would be to me would be probably $250,000 to $300,000 a year in income. And why is that the case? Because when you start to get to that tax bracket, you're in like a 24%, 22% bracket. One, you've got some discretionary earnings in order to be able to do some sort of tax planning. And you also are in a more painful situation as you kind of move up the income thresholds where it makes more sense to try to be more strategic, look into other alternative investments like short-term rentals outside of just the typical maxing out my 401k, my HSA, and 529, that kind of typical good stuff. But we might want to consider other assets as well. So that was a whole bunch. Hopefully that wasn't too much, but let me pause there and see if there's anything you guys think I should talk more about.
It's so interesting, as you were kind of explaining, your background, your journey, what you're focused on today, et cetera. It made me kind of think to myself, one common theme that I notice a lot in folks that have kind of success, I would say, in the investing space is really two ingredients. Number one, they get educated, and number two, they take action. And as you were explaining to me, your decade-long experience, in the real estate space and your desire to learn about different tax strategies that are available out there for the high net worth investors and individuals, it just reminded me of one simple thing. And that is so many people reach out and say, Jeremy, you make it look so easy. Jeremy, we want your story to be my story. And at the end of the day, it really comes down to the fact that I got educated. I sought the information so that I could learn and really take ownership of my own investing trajectory. But number two, I took action. And yes, I had plenty of failures along the way, but you learn from those failures and you fail forward, right? Then you kind of learn, different strategies. So I'd really like for you to kind of answer one big question, that I know a lot of people that are listening to this podcast are going to want to hear from you. And that is, what's the biggest misconception that you would say that high income earners have about taxes in general?
I mean, I could probably say 5 things. The one of the first ones that comes to my mind is actually a misunderstanding between, if you don't mind, I'll say 2 things. One is more so just like a silly thing, but the first and foremost is kind of tax brackets. As I was kind of talking about just a few minutes ago, people think, hey, I'm in now the 24% or I'm in the 32 or the 35 or the 37% tax bracket. One major misconception is that just because you get into a tax bracket, it doesn't mean 100% of your income is now taxed at that tax bracket. So basically, we've got kind of a progressive tax code, which basically says, hey, the first don't quote me on this, and it depends if you're single and married. The first 50,000 is taxed at 10%, and then the next, between 50 to 150 is taxed at 12, and then 150 to 250 is taxed at 22, and so forth, right? Now, a lot of people think it's like, oh, once I hit this bracket, 100% of that income is taxed at that bracket. So that's a very common misconception, which makes kind of the actual calculation of your taxes and so forth a little bit more complex. So that's kind of the first one, a huge misconception that I typically see. And therefore, like, people do a lot of math incorrectly, kind of assuming that they're going to get way more tax savings than is actually going to be realistic. That's typically what I see when you see things on Instagram or TikTok. It's like, oh, I'm in the 37%, and therefore I get a $250,000 loss, and all that's going to be at 30. Well, not quite, right? It's not necessarily going to be that. Then you've got state implications and so forth. But the second one, if you don't mind me, Jeremy, the second one is that, hey, if I put something into an LLC, therefore now it's a business. And now anything I run through that LLC is completely tax deductible, and I get quote unquote more tax savings. That's completely false. Just simply by having an LLC or running expenses through an LLC, number one, doesn't make it any difference if you had an LLC or not for the deductibility. But it doesn't also mean that you can run personal expenses, right? If I go get let me use a bad example. If I go out to, cut my grass and I need to go get gas for my mower, something like that just because I might run that, receipt through an LLC, business card or something, doesn't mean it's tax deductible. It's still personal, right? And so that's another kind of misconception, that even people who are in passive or active investing, that's a common thing that I see pretty often.
Yeah, that makes total sense. I want to tell you just a little bit of a story about myself, and that is when I started a private equity real estate company with the goal of attracting investors' capital to place into our projects and properties. I was able to leverage my wife, who was a homeschool mother at the time and still is today, but we've only got one homeschooler left at this point. We were able to leverage her working 750 hours per week on active real estate related activities. For example, we rent out our RV, which qualifies as a short-term rental. We have a boat slip that we own, in a marina, and we rent that out. We have a single family home that we still own and operate. Plus I was building up our private equity, real estate company called Starting Point Capital, all at the same time. I was grinding out a commission check and a bonus check in the tech sales space, to which I retired from, about a year ago now. But during that time that I was still crushing the paycheck, crushing the W-2, I was able to, for my wife, I was able to leverage real estate professional tax status for her, because we were able to tabulate and track her active real estate related activities, which met or exceeded that 750 hour per year threshold, so that I could then use my passive loss depreciation on my passive real estate investments in order to reduce my active ordinary income in my day job. It took me from I don't know what the highest federal tax bracket is. I think it's like 37 or 39%, right? I was able to reduce it from 39% all the way down to 12% in the year that she checked that real estate tax professional box. And she only needed to actively work for 750 hours per year, which was doable for her because, again, she did not have another occupation outside of the home, right? And as our children started to get older, her demand as a homeschool mother continued to decrease. And so she had more bandwidth in order to be able to spend time on those active real estate related activities. So I'd like to just maybe kind of, from your vantage point, learn a little bit more about kind of my strategy and what you kind of think, and maybe how others can, leverage the same.
Yeah. If you have, for whichever of you as a spouse might be listening, it is very, very, very common that you have one kind of working spouse, kind of the high income kind of breadwinner at home. In the home, in the marriage. And then you've got someone who is either staying at home, working very, very, very part time, that is able to then potentially meet the real estate professional status. Before I kind of walk through that a little bit more, I just want to kind of start a big picture to say it holistically for anyone listening to this. So big picture, there's really two primary steps with real estate professional status. Number one, and it's going to be kind of two sections here. So 1A is really like you said, Jeremy, 750 hours in a real property trade or business. Okay. And then 1B to that is that it's also more than 50% of your working time. So that right there makes it very easy for someone like your wife, Jeremy, who is not having another kind of full-time employment or even part-time employment, that she doesn't have that issue because there's nothing really to compete with her time except for maybe the homeschooling. But I've never seen a court case where someone's gonna, go against like, oh, your homeschooling though, is that, more than the homeschooling time? I've never seen that. It's very typically more like you have a wage, you're an employee, you're a business owner, and they're going to compete against those sorts of things. So yeah, generally, if you've got that kind of a situation, one spouse is working full time, the other is not, and taking care of more of the family things, the personal things, or kid things like homeschooling, that is obviously the 1B is going to completely remove that issue. And then the primary one is really the 750 hours, right? And just for those of you listening, if you've got a full year and you're like, hey, I can't do this year, right? We've only got 2.5 months left of the year, but I might want to pursue this for 2026. Hey, guess what? That's about 15 hours a week. Okay. 50 times 15 gets you to about that 750 hours. So that's 15 hours a week. That's not 40. Okay. So for those of you listening, it's not a full-time job. It's hardly part-time. So just for those of you thinking like, is this realistic? Absolutely. Not in 2025 if you haven't started. For 2026, absolutely possible. Okay. But then part two, kind of step two, is that you materially participate in your long-term rentals. Okay. And that is the place where if an IRS agent is going to audit something, it's going to be usually this part right here, because the 750 hour in real property trader business is a little bit more loose. It's kind of a bigger circle of kind of what's involved. But material participation in long-term rentals is much more specific, and it's a much kind of smaller kind of sphere of like what could be included, right? And you've actually got to show kind of between a couple main categories. One, that you are basically a part of management, usually is going to be a big part of it. But even if you're not with material participation, then it's going to be something around like improvements or repairs or taking care of like a remodel or reconstructing something like that, where you're kind of physically involved in the real estate itself, in your rental, right? Keep that in mind. So you've got kind of the two main steps, and it's possible for probably next year for a lot of you, but keep in mind, it's not, I just don't want people to get the impression, oh, it's just 750. It's a lot more complex than that. And hopefully you've kind of heard that with my literally, couple minute, conversation here with you guys. But it's 750 more than half your time, and you have to materially participate. And a common question I get here is, wait, is there overlap with kind of that step two, material participation, in the 750 hours, in your real property trader business? There absolutely is. But only kind of material participation can go into the first step, the 750. But sometimes you'll have time in 750 hours, which would be like you're a realtor. Okay. I have a lot of friends who are realtors, and basically they will say, oh, I'm a realtor. I do this 2,000 hours a year. I'm good. And I will just say, not necessarily. Are you materially participating in your rental? Right? You've got to do both. Right. And there can be overlap, but it's not just a simple, oh, I'm in real estate in general, and therefore I qualify. You've got to be involved in the rentals itself, whether it's management or it's going to be kind of that physical work. So it's absolutely something that can be done.
I'm Zach Haptonstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investors. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
I think you're kind of alluding to this kind of short-term rental loophole here. And so can you explain to our listeners, why leveraging that short-term rental loophole specifically can be so powerful, from a tax perspective?
Yep. So short-term rentals is a different tax strategy from real estate professional status, but the reason that it's so lucrative and why I have most of my clients that I work with using the short-term rentals is because we don't have, dissimilar to real estate professional status, we don't have a 750-hour requirement, and we don't have a more than half your time requirement. Okay. The main difference as we kind of think about the different tests in real estate professional status and the short-term rental strategy is we take out kind of 1A and 1B, and we actually insert, when it comes to the short-term rental tax strategy, an average stay per guest of 7 days or less. So it's a very common Airbnb, these kind of vacation rental or vacation market areas, that they are going to be really just kind of weekend stays, right? So you might have, I typically see my clients have more like a 3 to 4 day average. That's very common. Okay. So we've kind of met the first part of this strategy. That's step one, average stay less than 7. Great. And then the second step is very similar to real estate professional status with material participation, except it has to be material participation in short-term rentals. Okay. So short-term rental strategy is for short-term rentals. You guessed it. Okay. It's not meant to be some sort of secretive, crazy thing that makes this really complex. But real estate professional status, that material participation, that is for long-term rentals. Okay. So again, for those of you who are listening, why the short-term rental tax strategy is so big on Instagram and TikTok and tax strategists in general is because we don't have as significant of a time requirement. So as we think about step 2, and you're asking yourself, well, how much time do I have to put in? Well, there's 7 tests that the IRS have given us. And the most common one I see with my clients is either the 500-hour test or the 100 hours and more than anyone else test. Okay. So what I typically see is that my clients say in fourth quarter, third quarter of the year, they will go buy a short-term rental. They'll get it up and running. They'll get several stays throughout the year, as many as they can. And then they're going to go do a bunch of the furnishing. They're going to do the first major clean. They might be a part of the, setting up some improvements or repairs that they're going to do, or landscaping. And maybe in the first week, if they go down there for a week or several days or a couple weekends throughout the year, they're immediately going to get 100 hours, right? And then if they're involved in the management, they're going to get a few hours throughout the year as well on top of that. And then they're really just going to be competing with someone like a handyman or a cleaner or whatever. And you just need to make sure, if we're going for specifically the 100 hours and more than anyone else rule, that you have, just like I said, more than anyone else. So if you're going for that one specifically, which obviously has 400 hours less in a time requirement minimum, you need to make sure that you document your cleaner's time, get your handyman's time, get whoever else is involved. If you have a property manager, get their time, so that you can prove, if you're ever under an IRS audit, hey, I got 200 hours and the next closest person to me got 150 hours, whatever it might be. Okay. So that's why that one's more common, is because the time required, kind of the minimums, are so much less. That's the main reason. And it's ultimately going to require just ultimately less time and less requirements.
Yeah. So let's talk about the tax benefit side of this. And I don't want to assume that our listening audience understands terms like cost segregation, accelerated depreciation, and now bonus depreciation back at 100%, right? So I'd like for you to maybe kind of unpack in layman's terms, really I'd like to maybe focus primarily on this cost segregation, because a lot of people don't understand, how is it that a cost segregation study or a third-party engineering firm that comes in to perform this cost segregation study, and then all of a sudden at the end of the year, my K1 for an investment year one, has a passive depreciation loss recorded on it of, 60, 70%. Like, where did that number come from, right?
Right. Yep. So probably the first thing to say, and we should make sure, Nick had a question earlier, so let's make sure we get to him in a second. But Nick, let me get to this real quick. So first, I just want to say the short-term rental tax strategy, why it is important is because it is taking a normally rental property, which is by default passive since the Tax Reform Act of 1986. And if you meet the short-term rental tax strategy, all those 2 steps, 7 days, material participation, it is now making that a non-passive, some people call it active, that's not technically the right word, but non-passive investment, which means that any losses from that short-term rental could offset your W-2 or your business profits. Okay. That's why this is so significant, because the default is that it won't. Okay. The default is that short-term rental, if you don't meet these short-term rental requirements, is going to be passive. And guess what? You have losses that might get generated even if you did a cost seg. That's just going to sit there and it's going to get suspended. It can't offset your W-2. It can't offset your business profits. So that's why this is so important, because it's going to turn it into a non-passive asset, a non-passive real estate asset. Okay. But why the cost seg comes into play? Basically, a cost segregation study is just going to take the component parts of your real estate and it's going to break it down into its various parts, like 5-year property, which is going to be personal property. That can be things like light fixtures, appliances, carpet, things like that. You're also going to have, from the cost segregation study, they're going to show you, hey, some of your purchase was actually 15-year property. That's typically just called land improvements or site improvements. That's going to be things like driveways, sidewalks, decks, things like that, pools, in-ground pools. And then you're going to have your 39-year property, for example, for non-residential, which would be a short-term rental. That's just going to be things like the roof, the walls, the windows, the doors, the floors. Okay, kind of like the concrete floor and all that stuff. So those are kind of the major components. You've got 5-year, 15, and 39. But if you never got a cost segregation study done, and let's say you bought a $1 million property, a short-term rental, everything is outside the land, which you're going to have to take out first. Outside of the land, all of that building is just going to get depreciated over 39 years, just flat amount, the same amount for the next 39 years. But a cost segregation, an engineer is basically going to take a look at your specific property. Usually they're going to take pictures, or they're going to do a site visit or a virtual one. And they're going to say, hey, you've got this much, we think, in countertops. You've got this much in carpet. And you've got this much in appliances. And now they're stripping out what would normally have been all depreciated over 39 years. And now it's getting depreciated faster, okay, into 5-year or into 15-year. And the reason that is so significant in today's world, especially with the one big beautiful bill that came out in July, is because now we're back to 100% bonus depreciation. So all of the cost seg and the 100% bonus is all just kind of a form of helping us accelerate depreciation, accelerate our deductions from the property itself. And so accelerated depreciation is a bit more of a generic word. And the 100% is how fast are we accelerating it, right? So you've got a cost seg, which is going to split out the components. That's going to get us the ability to accelerate depreciation. And now 100% bonus is because we're in where we are. If you bought a property now, anything after January 19th, 2025, we can now take it at 100%. Okay. So that's kind of the combination. Is like the cost seg helps you get all these components. We can then accelerate it. And because of where we are now, we can get 100% bonus.
That makes total sense. And I do want to grab Nick's question here, but just one moment. Okay. One moment, Ryan. One kind of follow-up question, and that is, can you explain depreciation recapture and why or why not it could be considered to be a negative, when the property is effectively sold?
Yep. So depreciation recapture is anytime you have a sale of the property. Now, basically what you're doing with the cost seg and accelerating depreciation and the 100% bonus now is that we're taking all that kind of what would have normally been over 39, and we're taking a big chunk of that, which we typically see is about 20 to 30% of kind of 39 years now getting reallocated to the 5 and 15. We're basically getting those deductions right now. Yeah, we're getting all of it, especially with 100, getting it all right now. But if we go and sell the property next year or in 2 years and 3 years, if we don't do anything else, yes, we have to recapture that. So it kind of stinks because we got the deductions and then we're just recapturing that as income. That's depreciation recapture. It is a type of income. So we have to get that back. Now, that does become a concern if you're going to sell, but I will just mention there are solutions to make that not as painful. Either one, you can do a 1031 exchange, which means you're just kind of kicking that depreciation recapture down the road. And if you keep doing that and you never actually fully sell without a 1031, if you then give that to your heirs, they then can get a step up in basis and that tax is permanently gone. Indefinitely, it's gone. It's called deferred, die. Okay. Maybe a bit morbid, but it is one of the biggest wealth building, especially with real estate tax strategies that is out there. You talk about these cost segs and real estate and short-term rental and all that stuff. That's great. But if you can multiply that with everything that I just said with the deferred, basically just sell a 1031, and then give it to your kids and pass away, that is the ultimate kind of wealth transfer in my opinion. That is like the mega tax strategy, very long-term thinking, huge wealth benefits there for kind of your family and what you want to do with your wealth.
If you don't execute a traditional 1031 exchange though, right? Is that depreciation recapture a 1-for-1 related to the tax benefits that you received? And then you've got this recapture at the end. Is it a 1-to-1 or is that recapture something less than the tax benefits that you already received before the time of sale?
Kind of a tricky question because it's partly so part of the 5-year and the 15-year property, basically that is going to be basically at your ordinary income tax rates. So if you got the deduction in the year that you took the cost seg, and let's say you're at the 37% bracket, great, you got a 37%. We're just talking federal, just the 37% bracket. But then if in the year that you sell it, maybe you're actually at a lower tax bracket in that year, right? Maybe you are working part-time, you're just starting a business or whatever it is, and maybe now you're in a 22 or 24% bracket. Now you're actually recapturing that at a lower tax bracket. So you ultimately won, right? So you are paying less. Now, if you're in the same bracket though as when you got it, yeah, you are selling it then at some of that ordinary income tax, the same thing. However, if you took that, tax savings that you got back in, the original year that you did the cost seg, and you invested that into savings, a stock market, or whatever, and you invested that, and that money over the next 2, 3, 4, 5 years, however long you held the property, has actually grown in value. Well, even if you have to pay it back at the same tax rate, you still won because of that marginal difference of how that money grew, right? So it's just the time value of money theory is ultimately kind of what it comes down to.
And you're kind of basically you're leveraging the IRS's money to produce an additional return. I want to ask Nick. Nick, you've got a question. I appreciate you being so patient here. Nick, fire away.
So many questions to ask you. A lot of our multifamily investors are really drawn to the depreciation. So for a standard kind of passive investor, maybe they're putting $100,000 into a multifamily deal. How does depreciation and a cost segregation benefit a passive investor with no additional rep status, no short-term rental? They're just working their W-2 job, but they're wanting to grow their passive income. How could you say it? And maybe one way I've heard it is, where else can you double your money but only pay taxes on half of it? Is that a true statement?
Pretty much. Well, I'll tell you what actually I'm planning to do, which is a further conversation I'm going to have with you guys and a couple other people, but which is basically, so 2 examples. Okay. Number one, how the kind of losses with the limited partnership investment could help you is, number one, if you have a big real estate portfolio and it's actually producing a taxable profit for you, that can then be used, like passive can offset passive. Okay. So if you've got passive profit from 5 other rentals you have, and you're going to make a new investment and it's going to produce the equivalent amount of new losses, great. Now you've just completely neutralized all of your profit for that year. That's fantastic. Okay. That's option 1. I don't have that situation. Okay. Option 2, which I'm actually planning to do, is kind of called a couple of different things, but let's just, for the sake of this conversation, call it the lazy 1031 exchange. Okay. So I have sold, like I told you guys earlier on, I sold a 4-plex this year. And it had a decent gain. Yes, I had some other kind of passive losses that I'm now going to be able to unlock. But because I'm expecting the gain to be bigger than all my losses combined, I'm still going to pay tax. So what I can do is I can go say, hey, I'm looking for another passive investment. And now I'm going to take whatever loss I get from that K1, have it offset all my gain, right? So now I have a gain, I have all these losses, and I can utilize them all together in the same year. Now, the caveat, which is different from a 1031 exchange, except for all those rules with the 1031, you have to have the gain in the same year that you get the losses. So I had the gain in June 30th this year. I have to get the losses that have to come to me in the same tax year, 2025, in order for me to utilize this. So 1 is you have the passive profits, or 2, you have a gain that you don't have enough suspended losses that you need new losses. You can do that with a new investment as a limited partner.
And we see this a lot, Ryan, with a lot of our investors that have multiple businesses that are generating K1s, multiple investment properties, even their stock portfolio that do kick out gains. And some people invest with us just to get that loss to offset. So another way of saying that is, if you take that 1031, that lazy 1031 route, you're not having to kick the can down the road and lock up those funds. You could actually use those funds immediately versus having to wait. Is that a correct statement?
Yeah. So 1031, because and what's nice about the lazy 1031 or 1031 light, they both have kind of the same idea, is that you can kind of figure out how much. You can do the same thing with a 1031 truly, but you can kind of figure out, hey, do I just want to invest some of my proceeds that I got to offset some of this gain, or do I want to offset all of this? Okay. But one of the downsides with a 1031 light or the lazy 1031 is you have to do it in the same tax year. So if you are in a place right now where you're like, hey, I'm going to sell something, pretty soon here, and I've only got now 2.5 months, it's going to be tough. Okay. But if you're like, hey, I sold something in January, like next year, right? First quarter of 2026, you're like, hey, I've got a lot of time, which is great. gives you more time to evaluate sponsors, syndicators, whatever. But if we're getting down to kind of doing a 1031 light, because we're in the fourth quarter this year, there's just a limited time to be able to find your good investment.
Last question for you. We're kind of getting to the end of the episode. I'm hearing lots of different strategies here. We're getting to the time of the year, a couple months left. When do you typically start working with your clients? And is this a good time of year for someone to reach out to a tax professional like yourself?
Everyone's needs are different, but yes, now is a good time. Typically, when people are like hot to trot and looking to work with a tax strategist like myself, they're thinking about year-end tax planning, and they just feel like, hey, I've had a much bigger income than I expected. What else can I do? I'm not maximizing this. I know ChatGPT is limited and it's going to tell me I'm fallible. So if you just want to work one-on-one with a tax strategist and you want to get some ideas, or two, just some clarity and some questions answered, and or three, just kind of some long-term, like, hey, help me think through this, help me implement this, help me walk through this, and some overall planning, whether you're a high-income earner, W-2, and or you are a business owner, there is some opportunities now for year-end tax planning. Otherwise, I've heard people say, you know what? I think I've done everything I can for 2025. I don't think I'm going to make any other investment. I don't have any other sales coming up. Great. Then let's get started in quarter one of 2026. That's fine, because now we've got the full year to start implementing these things, kind of considering other things like the short-term rental tax strategy or real estate professional status.
Yeah. And Ryan, we know that not all tax advisors are created equal. So, what are some red flags that investors should be, on the lookout for when choosing a tax advisor?
Um, I typically say you get what you pay for. So if you find someone who is extremely cheap, just be very concerned about that. Another thing though that I would say is just how much experience do they have, and if there's someone. So I'm thinking about like people on social media that I know, people on TikTok, Instagram, whatever. They've got big followings, and it's because their advice sounds really nice, but they're not telling you the things that you need to hear. So they have a hard time saying, nope, that's not going to work because of this. They will tell you things like your Rolex is going to be deductible because it's inventory. Or they're going to tell you things like, hey, your birthday party with all of your family, that's a networking advertising event. Okay. So there's just silly things out there that if it sounds too good to be true, should be a red flag, right? If it basically takes no risk, if it takes none of your money, if it takes no documentation, and it just seems too good to be true, you should watch out. Okay. Because that doesn't make sense to anyone. Just like anyone you ever talk to who gets into a scam or a scheme. Yeah, it seemed too good to be true in the beginning. Almost everyone I've talked with, including myself, was like, oh, that seemed too good to be true, but I went for it anyway. Okay. So those are some red flags: being too cheap, not enough experience. But I would also just caution people who are just talking to someone who only files taxes. That's a tax preparer. That's very different from a tax strategist. And I'm primarily a tax strategist. I have kind of the ability to file taxes and so forth, but you want to actually look for someone who has years of experience in doing that, not just someone who's like, oh yeah, I can do it for $400. Okay. Red flag to me, at least, would be that. But how can I help you actually maximize tax savings, not just file your taxes for as cheap as possible in the filing itself?
Yeah, Ryan, that's great advice, and you brought tremendous value to us. Before we kind of wrap things up, I'd like to ask you one kind of maybe last question, personal question, and that is, really, what is your why? On a personal level, what is your why that you kind of get up, every day and just make a decision on a daily basis to grind it and provide for your family?
Yeah. Number one, yeah, is just to honor God with kind of my time and my talents and my treasures. Yeah, He is the one who is giving me everything I have, and so I just want to first and foremost bring glory to God, and I want to do that through working hard. I want to do that by helping people, and that just comes through kind of what I do, and hopefully people see that in the integrity that I have to try to do everything well, as a high quality, and to be very fast and responsive and to take care of my clients. So I want to do that. I also want to support my family. And I think as I work hard and as I do these things, that just kind of comes naturally, and the Lord will provide kind of as He sees fit. But yeah, that's a big part of my why, is just to honor God in what I do and provide for my family, and to love my neighbor as myself. Ultimately, I just want to do that because that's the golden rule. I want to follow that and obey that.
Yeah, amen to that. And I appreciate you sharing that. What might be maybe one or two different ways that our listening audience can connect with you offline to learn more about, what you're up to?
Yeah. I just kind of got my website up and running, so hopefully you can find it. CarriereTaxConsulting.com. Yes, it's Carrier, like aircraft carrier with an extra E at the end. So be careful of that. Otherwise, find me on LinkedIn. You can find me there. At some point in the future, I might have a YouTube channel, things like that. But LinkedIn is kind of the place I'm most commonly on. BiggerPockets, I'm going to be kind of commenting, answering questions there a little bit too. But yeah, LinkedIn will be the number one. Otherwise, my website.
That's great. Well, we'll definitely put those links in the show notes for the episode. And Ryan, again, thank you so much for the tremendous value that you brought us today.
Thanks, guys.
Yeah, awesome job, Ryan. Thank you.
And listening audience, thank you again for jumping into yet another episode of the On the Rise podcast. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the On the Rise podcast. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decisions, please consult with a professional. This show is copyrighted by the On the Rise podcast. Written permissions must be granted before syndication or rebroadcasting.